Hello students, this is a recording to go through the procedures for closing the ledger. If you see this pen symbol here, that indicates that if you're using the worksheet, that there's some information for the worksheet at that point. And of course, just pause the slide if you need to complete the worksheet. So, closing the general ledger. So at the end of the reporting period, two processes need to be completed. And the first one is balancing, which you are familiar with. And balancing, of course, is reducing all entries in the ledger down to one figure that shows the overall balance after all the transactions for the period involving that one ledger. So you've already done and should be familiar with that process. These ledgers have balances that will carry forward to the next period. So, of course, that's your assets, your liabilities, and your capital. The second process, which is what we're looking at today, is closing the ledger. So revenue and expense accounts should be closed off to the profit and loss summary account, which is our new account. So closing means closed off, means to transfer the amount to another ledger, to clear the ledger and return it to zero. So the amounts in these ledgers, the revenues and expenses mostly, only relate to the current period, so they don't carry forward. So that's why they need to be closed rather than balanced. So they need to be closed off to work out the profit for the period. So that brings us to why close accounts. Revenues and expense accounts should be closed off for two reasons. So these are the reasons you need to know. The profit and loss summary account uses revenues and expense accounts to determine the net profit or loss for the period. And so we do need to work that profit out in the ledgers as well as in our income statement. And secondly, revenue and expense accounts are returned to zero balances, ready for the next reporting period. This ensures that this period's revenues and expenses are not counted again in the next period. So they don't carry forward. They don't relate to next period. They only relate to this current period. And so therefore they should be returned to zero in order to have fresh revenues and fresh expenses for the next period. Now, the theory related, the accounting assumptions are period assumption. Reports are prepared for a particular period of time, which you'll be familiar with. And performance can then be measured by calculating profit by recognising the revenues for the period and deducting the expenses occurred in the same period. So that relates, of course, to period assumption. And the other, of course, is accrual basis assumption, which is alluded to in that previous point. This will ensure that only revenues and expenses that have occurred in the current period are used in the determination of profit. And performance can then be measured by calculating profit by recognising the revenues earned for the period and deducting the expenses incurred in the same period. The qualitative characteristic that relates is relevance. Information should be included in reports if it is capable of making a difference to decisions, right? So that's your basic definition. In this case, of course, the decisions are about profit because this particular topic is all about profit. And profit calculation should only include revenues and expenses, of course. They're the ones that are capable of making a difference to decisions about your profit, not unrelated items such as loan repayments or drawings. And also, revenues and expenses should be included if they occur in the current period, not outside, such as last year's wages or next year's revenue. So that is, again, alluding to the period assumption. So to sum up, the information is capable of making a difference to decisions about profit are only revenues and expenses as they are relevant to determination of profit, and only revenues and expenses that have occurred in the current reporting period. Right, so there are 4 steps in this process. Step 1 is, first of all, closing revenue accounts. So at the end of a period, a revenue account will have entries on the credit side. So here is a typical looking revenue account. In order to close off this account, a debit entry of an equal amount to the credit side is required. So obviously it's $10,000. To close this account, you would have to put a debit entry worth $10,000, and that means both sides are equal and it will be closed off. So an entry is prepared in the general journal, so we will debit the sales revenue account and credit profit and loss summary. And then we post to the general ledger. So there's that sales with those sales recorded, and there is the debit to the ledger. Here it is here. So the total of all revenue accounts here is what goes to the profit and loss summary. So here's the example from the book. Typically you'll have a few revenue accounts: sales revenue, discount revenue, inventory gain. They are debited because there'll be credits in their individual accounts. Notice also sales returns is a negative revenue, and it'll have a debit in its account. So to close it, you will credit it. And then the net amount, $34,700, is what will go to the profit and loss summary account. So note how all the revenues are closed in one general journal entry, with each individual revenue account debited, but one credit to the net revenue figure, the profit and loss summary account. So just the one figure goes to profit and loss summary. So you do all your revenues in the one closing entry, and you just take one figure to the profit and loss summary account, in this case, $34,700. Just a few notes on the profit and loss summary account. It's a temporary owner's equity account, and it only exists for that determination for profit or loss for the period. So it only exists for that one calculation. It's also a summary account, so individual detail is not needed, just the totals of revenue and expenses for the period. So it's a summary account. And then the profit and loss is transferred to the capital account because the profit or loss belongs to the owner. This means that the profit and loss summary account is in fact closed itself, right? It only exists to determine the profit or loss and the difference, which is the difference between revenues and expenses, and it ends up going to the capital account. All right, so complete the example on the worksheet. And here is the solution for that example on the worksheet. Closing off the revenues. Here we have them, the sales and the discounts. So you'll debit the revenues and you will credit the profit and loss summary account with the total, $14,330. Right, the second step is closing expense accounts. The following expense accounts were found in the ledger. So these are just some typical ledgers, and of course they'll all be debits. Okay. So a general journal entry is required to close these expense accounts, and of course they are credited and then transferred to the profit and loss summary account. So here you can see them. We credit the expenses and one debit to the profit and loss summary account. Closing entries are then posted to the general ledger. So here's those ledgers from before with those credits in them. Both sides are equal, so the accounts are now zeroed and they have nothing in them, ready to start fresh for the next period. Complete the example on the worksheet. And here is the solution for that one exercise. So note here, the expenses are credited, and then you've got one debit to the profit and loss summary account, 9340. So the profit and loss summary account. When the closing entries are posted to the general ledger, the profit and loss summary account brings together the revenues expenses closed off for the period. So here are those revenues of 10,000 and the expenses of 7. Now just showing you that ledger, that's where that 10,000 came from, that sales ledger that we had before. All right, there's the credits and there's that one debit. And notice the cross-reference. We just write revenues. It's a summary account, so we just write revenues. And the expenses, I've got that general journal entry. There was that debit, right, of 7,000, and so there it is. And we just write expenses as the cross-reference because naturally there's several expenses. The difference between the revenues and expenses will be the net profit or the loss for the period. In this case, the revenues of 10,000 minus the expenses of 7 gives you a profit of 3,000. So that brings us then to the next step, which is the transferring to the capital account. So that's step 3. The net profit or loss of the period is then transferred to the owner's capital account. So here is an example of a general journal entry. There's that 3,000. You will debit the profit and loss summary account, right? Because here was the 10,000 and the 7. And so the difference is 3. And so that goes to capital. So note that this account now is closed. Both sides are equal. The balance goes to the capital account, right? $3,000 is the profit because revenues were greater than expenses. Complete the example on the worksheet. And here is the solution for the example on the worksheet. We have a profit of 4,990. And so we will debit the profit and loss summary account because revenues are greater than expenses. So the smaller side is the debit side, and we'll credit the capital, which makes sense. If you're making a profit, we'll increase capital, and that would be a credit. So that's a standard entry to transfer a profit to the capital account. If it was a loss, of course, it would be reversed. You would debit the capital account and credit profit and loss summary. Step 4 is transferring drawings to capital. Drawings will have debit entries, so a credit is required to close it to the capital account. And so here is our drawings, right? And drawings will always have a debit in it, so to close it, you'll credit, and here is the debit to capital. So remember we said that drawings would come back home to capital, and this is the entry to bring it back home, to debit it to capital. So just a note on drawings. Drawings has a separate ledger, and that's so all the owner's transactions for a period can be identified. It allows the drawings to be compared to the profit to determine whether it's at an appropriate level. So we want to make sure the owner isn't taking out too much of the business's resources and leaving enough in there for it to continue. Complete the example on the worksheet. And here is the solution for the example on the worksheet. There was drawings of 4,000, so that you just credit drawings and debit it to the capital. And then just completing the process. The owner's capital account can then be updated with the profit and the drawings for the period. So here we have a balance at the beginning. There's that $3,000 profit. There's the drawings. And so overall, when you finish off and you do your balancing, the owner's equity has increased from 50,000 to 52,000 for the period. So complete the example on the worksheet, and don't forget, of course, to have a look at the example in the textbook, Pulse Music Shop, around page 260, and then have a go at doing a couple of exercises from the chapter 10.1 perhaps and 10.3. Here is the solution for the example on the worksheet. with the profit and loss summary. So remember that it's a summary account, so we just write revenues and the total from that entry in the general journal, and the same with expenses, just the total, and then the difference, of course, is the profit. We don't write profit, it gets transferred to the capital account, and so here it is here. And of course the drawings as well. I haven't balanced this one. Of course, if you were completing the ledger, you would balance it off. All right, so hopefully that has helped you understand the closing process. Pretty straightforward. Just remember the 4 steps, do them in a logical sequence, and you shouldn't have any difficulty. And make sure you practice a couple of exercises that have a net loss as well. Good luck.